Welcome back to Big Future Little Steps. If you tuned in to parts 1 and 2 of our series, then you've learned how to be more strategic and tax savvy with your retirement savings. And you're also familiar with our two sample savers, Johnny K and Johnny Cash. Where we left off, Johnny K's path to retirement was going pretty smoothly. He's already well on his way to achieving his goals. But what about our other saver, Johnny Cash? Well, I guess you could say his path was a little bumpy. Little did Johnny Cash know, putting his short-term wants ahead of his long-term needs was eventually going to catch up with him. Johnny's not very happy with how his savings have progressed, and he's getting worried, so he's decided to go it on his own. But with the market so vast, and with so many investments to choose from, how do you even get started? There are many factors to consider when deciding to invest in the financial markets. To start, it's important to think about the factors that affect your personal situation, the years you have left until retirement, and how much risk you're willing to take with your money. And that's where diversification comes into play. Diversification is a technique used by investors to reduce investment risk. Imagine a basket of fruit, bananas, apples, oranges, you name it. They're all the same type of food, they're fruit, but each has its own unique characteristics that set it apart. The same concept applies to investment diversification. At a high level, it's the process of spreading your money across different parts of the market, different asset classes with different characteristics, so you don't risk all your earnings on the success of one venture. You can sum up the concept by saying, don't put all your eggs or fruit into one basket. For instance, investing in one company could make your money grow, so long as it's doing well. But investing in that same one company can also break your bank if the company starts doing poorly. Still with us? Let's see diversification in action. Imagine that Johnny K and Johnny Cash's retirement portfolios are each an elevator going to the top floor of a skyscraper. Each investment in their portfolios is an elevator cord, pulling them up and down. After meeting with his advisor, Johnny K decided on a portfolio with a diversified mix of investments. Some of the investments generate more return, but are riskier. Some of the investments make less return, but are safer. Even if one of the investments in Johnny's portfolio starts to underperform or pull him down, a few stronger chords or different higher performing investments will pull him up, creating a smoother ride to the top. Now, let's go back to Johnny Cash. Because he's worried about falling behind on his retirement savings, he makes a rash decision. Instead of investing in a well-diversified portfolio, Johnny Cash is taking a chance on one company, a hot stock tip he heard from a friend. At the time he heard the tip, this company was experiencing strong growth, but over the past few months, it hit some unexpected rough patches. Since putting all of his savings into that one stock, Johnny Cash's portfolio has been on a roller coaster ride. It's had some good days and some really bad days. In fact, the ride becomes so bumpy that he withdraws his savings and puts them all in a newer, hotter stock. Are you getting dizzy? The truth is, Johnny Cash's reaction isn't unusual for an investor without a diversified investment strategy. After all, money can be very emotional, but it all hinges on discipline. Research shows that behavior can have a severe impact on the returns you receive on your money, up to 1 to 3% per year. It's an outcome Johnny Cash probably wishes he would have known when he decided to abandon his 401k. In the end, the single company in which Johnny Cash was invested goes bankrupt. Johnny K, on the other hand, put the benefits of diversification to work for his savings. He tuned out the noise and short-term speculations, choosing to keep his sights set on his focused, long-term plan. Nobody knows what the future has in store for the markets, and like Johnny K and Johnny Cash, you're probably investing for goals that are 10 to 20 years or more into the future. By staying diversified, disciplined, and out of the guessing game, you'll be in a better position to capture higher returns on your money and have the foundation in place to protect your hard-earned savings against whatever comes your way. Where will Johnny Cash go from here? How will he recover his savings and make it to retirement? And more importantly, how much do you even need to retire? Get the final conclusion to our story in the next edition of Big Future, Little Steps.